So imagine you have a property and it makes, what does an average rental, short-term rental in Nashville make? $750,000. That's what we're going to go with. Makes $80,000. You have to self-manage this. You can't turn this over to a property management company. That's how you get the short-term rental loophole. That property, even though it was bought for $750,000, you have to deduct out land. Land is not depreciable.
So we have $600K for the property. So that's our baseline for our next venture here.
Once you pull out the land value, you have $600,000 of workable money, right? Now you take this number, and you have 5, 7, and 15-year asset classes. Everything from a cost segregation study that is important to your client is going to fall into these 3 years. You don't care about 39 anymore. Get that off your plate. You don't care about it. You will get 30 to 35% of this number depreciated in the first year. That's $180,000. That's huge. Now, let's talk about how to make it bigger.
So we have the $750,000 house. We have $600,000 baseline of the house because we pulled out the land. We have $180,000 of depreciation in year one.
But that's not where it ends.
It makes $500,000 a year, and it's realistic to believe that a lot of people buying short-term rentals do make $500,000 a year. So you have your cardiologist at Vanderbilt that just pays a lot of money to the IRS every year. They're not into real estate, and you show them, hey, you could, in lieu of paying the IRS this money, the money that goes to the IRS, you could take and put it towards a down payment on a house. But now you have an asset instead of just burning money to the IRS. So this person makes $500K a year.
That's correct.
This is where you can educate your client.
All right, $500,000 a year is going to put you into the 37% tax bracket. 37% of this is gone to your client. How do we get it back? 37% of $500,000 is what? And that's not how it's done. It's a progressive system, but we're just going to do basic numbers. It's $185,000, right? So he pays $185,000 in taxes.
But now he's depreciated $180K. So now their income is based off of $320,000.
So he's bringing home $320,000, right?
Per the IRS.
Per the IRS. The IRS gets $185,000. Well, how do we get this money back? If this property is cash flowing, what did we say it was cash flowing? $80,000. So you actually have to go 500 plus 80, 580 minus 180 for the depreciation. These are just simple numbers. There's a bigger formula to it than this. But now you brought him to 400, and he's already paid in 185, right? So now he's really back to 575.